Welcome to the July 2026 edition of This Month in Payroll. I'm Alana Hayduck, a partner in PwC's workforce practice. We hope that you had a successful year-end and a smooth transition to payday super. This month, we will focus on superannuation guarantee opt-out for high-income earners with multiple employers, PAYG withholding, STP reporting, and superannuation obligations on payments to directors, donations under a workplace giving arrangement or salary sacrifice arrangement, and payments to an employee that are a restricted covenant or a restraint of trade. So let's turn to our first topic of superannuation guarantee opt-out for high-income earners. From 1 July 2026, a new superannuation guarantee opt-out for high-income earners commenced, whereby an employee can apply to the ATO for a certificate to opt out of receiving superannuation guarantee contributions if both of the following conditions are satisfied. Firstly, they have more than one employer in the financial year. This includes being employed by more than one employer at the same time or switching employment from one employer to another during the financial year. And secondly, they expect the compulsory superannuation guarantee contributions from these employers to exceed the concessional contributions cap for the financial year. An employer who receives the superannuation guarantee employer shortfall exemption certificate will be released from their superannuation guarantee obligations for a specified period ending at the end of the financial year. It is important to note that an employer can choose to disregard an exemption certificate and continue to make superannuation contributions. An employee must apply to the ATO using the approved form, and the ATO must receive the application at least 30 days before the first day of the specified period to be covered by the certificate. An exemption certificate can only be for a period of up to one full financial year, and the ATO must have received the application by 30 May 2026 if it is to apply from 1 July 2026 as the starting date. If the application is approved, the ATO will issue a written notice to each of the employers covered by the exemption certificate. As an employer, you should validate the certificate by ensuring it was issued by the ATO, covers the current period, and verifies that the employee still receives super guarantee contributions from at least one other employer. Once you have validated the certificate, you are then legally protected from the super guarantee charge for not making contributions to that specific employee during the certificate's validity period. For single-touch payroll purposes, you should report the employee's qualifying earnings as zero for the period of the certificate's validity. If it is for a partial period, the employee will have year-to-date for the period superannuation contributions were required. Now on to our second topic of the PAYG withholding, STP reporting, and superannuation guarantee obligations for payments to directors. Payments to directors are generally subject to PAYG withholding. If the company is incorporated, it must withhold from payments paid to a director of the company or as a person who performs the duties of a director. If the company is not incorporated, it must withhold from payments paid to a member of or a person performing the duties of a member of its committee of management. Withholding is calculated by applying the ATO's published withholding rates to the taxable director's fees in the same way as for salary and wages. The withheld amounts must be remitted to the ATO. Where a company withholds from the director's fees paid, it would also have an STP reporting obligation in respect of those payments and the taxes withheld. In practical terms, this means the company must report the taxable director's fees, pay-as-you-go withheld, and the associated superannuation each time the director is paid. And the director receives an income statement at year-end based on the company's STP finalisation report. It is important, if the director's fees are paid through accounts payable rather than payroll, that the payments are still captured for STP and superannuation purposes. As directors are also treated as employees for super guarantee purposes, the director may apply to the ATO for the superannuation guarantee opt-out that I have previously discussed in this recording. Where you have a non-resident director, care should be taken to consider the implications of the payment of the fees under an applicable double tax agreement, as some agreements can source the income to Australia, even if the director has never been to Australia. Let's turn to our third topic this month, on the arrangements for administering donations for employees. There are two arrangements for donating employees. They operate through different mechanisms and carry different tax consequences. Firstly, a workplace giving arrangement is a post-tax payroll arrangement. The employee's gross salary is unchanged and the donation is made from the employee's own remuneration and is remitted by the employer to a deductible gift recipient at the employee's direction. Because the donation remains the employee's gift, the employer can reduce the amount of pay-as-you-go withheld to reflect the donation, so the employee receives the benefit of the deduction progressively throughout the year rather than on assessment. The employee still claims a deduction in their tax return. Alternatively, the employer does not need to reduce the tax withheld, and the employee claims the deduction on the return to reduce their taxes paid. The second arrangement is a salary sacrifice, which involves the employee agreeing to forgo part of their future salary before it is earned, in return for the employer providing a benefit of similar value. Where that benefit is a donation to a deductible gift recipient, the sacrificed amount is generally not salary and wages and is not accessible to the employee and is not subject to withholding. The employer claims a tax deduction in their corporate income tax return, and the employee does not claim a deduction in their own tax return. It is important to note that donations which are salary sacrificed are not considered qualifying earnings. An employer can choose to continue superannuation on the sacrificed amount, but should not report it as qualifying earnings. For most employers seeking to facilitate employee donations, a workplace giving arrangement is generally simpler and a lower risk option. It is important for an employer setting up an arrangement to understand the substance of what is being set up, clearly communicate the arrangement to the employee, and provide clear instructions to the payroll team, especially around pay-as-you-go withholding and qualifying earnings. Now for our final topic. We will look at the Australian income tax treatment of a payment made to an employee in return for agreeing not to join a competitor. This type of arrangement is commonly described as a restrictive covenant or restraint of trade. The key question is whether the payment is ordinary income or whether it is a capital receipt dealt with under the capital gains tax rules. The answer depends mainly on the timing of the payment and what the payment is truly for. A restricted covenant is in simple terms a promise not to do something. In this context, it is a promise by the employee not to compete with the payer or not to work for a competitor for a specific period or in a specified market. Restraint payments can have different tax outcomes depending on why and when they are made. A payment made when an employment contract is signed is generally treated as income. A payment made when employment ends is generally referable to a post-employment restraint and will generally be treated as capital. It is necessary to firstly consider the income treatment. If the payment is really an inducement or reward for entering into employment, continuing employment, or performing services, it is likely to be ordinary income. Even if the payment is described as a restraint payment, the substance matters. If the restraint is incidental to positive obligations to provide services, or if the payment is effectively part of an employment bargain, it's likely to be ordinary income. Where the payment is made post-employment, it will usually be capital in nature. There is one further layer to consider. If the payment is made in connection with the ending of employment, the employment termination rules may also be relevant. The practical takeaway here is characterisation is crucial. A genuine payment for a post-employment restraint is generally capital and taxed under the capital gains tax rules. A payment that relates to employment or services may be ordinary income, and where that payment covers both employment-related and post-employment restraints, it may require apportionment. To conclude, the treatment of a restraint payment depends on the substance, timing, and documentation. The safest approach is to ensure the restraint is genuine, legally enforceable, separately valued and reasonable. And that's it for our July edition of This Month in Payroll. If you would like to revisit any of our prior updates, they are available on our website at pwc.com.au/payroll. And if you have any questions or need for support, please reach out to myself or your usual PwC contact. Until next time, have a great month in payroll.